All right. So in this module, we're gonna discuss about leveraged and unleveraged model, because in a real estate private equity or a private equity fund, what I have seen, like private equity funds, they also contribute money, and sometimes they raise money from the banks on, let's say, interest rates 10%, 5%, 6%. Right. This is very common in US, UK, Middle East. This is something, it's a leverage model. Sometimes we call it as a LBO as well, leverage buyout. So it means fund can also contribute 20-30%, and remaining amount can be raised from the banks as a loan to acquire assets. And once that assets, let's say, generate some value or income, then the debt can be repaid, and remaining amount fund can keep with fund and distribute between GP and LP. So this is how basically, what I have seen, the different models. So as I said, so one of the investment model here, what we have seen in real estate is like leveraged and unleveraged model. So now if you ask me what is leveraged, it means taken loan from a bank and contributed own contribution to acquire assets. So that model, you can call it as a leveraged model, right? Unleveraged, it means it's a pure self-funded model. So it means private equity fund has funded everything, means they haven't raised money from the bank to acquire. So we'll now quickly discuss. I have a comparative model with me, so we'll go through the data and we'll see, or we'll analyze it, how the leveraged and unleveraged model works. All right. So let's say we have a Blackstone real estate fund 2 with the bank name like BNY Mellon, right? General partner is Blackstone Group, and they have, let's say, property of 1 million. Total equity investment, it means the Blackstone Group, they have invested around 0 point, let's say, or 300k they have invested, and 700k amount they have raised from the, let's say, BNY in this context. The rate of interest the BNY charged, which is around 5.5%. Look at this one. And annual income, let's say, the expected annual income from the property, which is 80k. And holding period, it means this is for 5 years with the appreciation for annual appreciation rate of 3 years. Even GP has commitment of 2%. Then LP has, of course, LP, they are expecting around 8% as a preferred return, and GP carry would be around 20%. So now let's discuss the model in details, or we'll compare it. I mean, two models will compare together, so to understand which model is better. Of course, I mean, each model is unique. Both model has their own pros and cons. So we'll discuss that in details. Now let's calculate it. Look at this leverage. First we'll go through the leverage model. Look at this, guys. So in terms of capital structure, so total equity investment 300k. So LP contributed 98% and GP contributed 2%. So it means total they have contributed 300k and raised debt financing. GP raised 700k from the bank BNY Mellon to raised $700k dollars, so that they will have almost, let's say, 1 million, and that 1 million, of course, they have invested to acquire assets. So now in the leverage model, if you look at the loan to value ratio, so loan to value LTV, which is at a 70%. So what it means in this particular model, so loan raised from the bank, which is a 70%, and they have contributed own equity, which is 30%. Now look at the operating cash flow, annual income, which is 80k, less annual interest, it will be debited. So annual net cash flow would be around 41k $500. All right. So now if I talk about holding period, which is for 5 years, you can just multiply it, would be around 20755. So then you can debit the interest paid, which is 190,500. So of course you have taken loan, it means every year will have to pay interest, right? So you need to debit the interest amount, which is 192,500k. So basically 192k amount basically will have to debit it from the net cash flow. Then disposition analysis. If you look at the, let's say, initial property value, which was at 1 million, Then appreciation, let's consider it 3%, it was appreciation in property. So future property value would be around 1.1 million, right? So you can then if you have, let's say, value of 1.1 million, then apart from this you just need to deduct the loan payoff. So loan payoff, it means, is nothing but it's a principal value that you need to first debit from the future property value, right? Then net sell proceed. So net sell proceed which has received from this investment, which is 459k, right? So now look at the details, total summary. Sell proceed which is at a 495k, and total cash flow from the property which is at a 207k. So it means around 616k dollars, the amount which is available for a disbursement, or the amount this is something available to distribute between GP and LP, right? And if I talk about, let's say, net profit, if you ask me from this model, so then you need to less the equity, because equity, it means this is a contribution of GP and LP's contribution. So net amount would be 366k. So this is something, it's a net profit from this leveraged model. So now if you look at the profit or total ROI, return on investment, which is at a 122.26. So almost more than 100% ROI has generated. And if we talk about the annualized ROI, it was around 17.32%. So this is how we can basically push ROI by taking more leverage. But if you don't have a, let's say, strong the asset in place, then you might get stuck with this debt trap, because debt trap, it multiply your risk double as well. If trade, or let's say if any assets perform in your favor, you may in profit. If that, let's say, perform against you, then definitely you would be in double losses. So while taking loans to acquire assets, so we should very, very sure about it. We should have to have a detailed analysis of it. So we cannot randomly go to bank, ask for a loan and acquire any assets. All right. So this is what something under leveraged model. So look at this, how fund manager manage the assets and generated huge return from the assets by taking loan from the Bank of New York, and that model will call it as a leveraged model. Now if I talk about unleveraged model, on other hand, look at this. See, all cash investment, no debt financing. It was 100% equity. Total investment, it was 300k. No debt financing, no loan to value that you need to calculate. Total capital, it was 300k. Let's say again, annual income, it was 80k dollar from the assets. All right. Then annual net cash flow, let's say, assume it was around 4 lakhs, but this won't be accurate, because if the property value, it was just only invested 300k. So of course this investment means annual income would be also impacted. But anyways, in this model, we have treated like income would be 80k, which is fine. Then annual net cash flow would be around 400k dollars. All right. Total interest paid 0, because you don't need to pay any interest as such at the moment. Then disposition analysis. Let's look at this figure. Initial property value, which was at 300k. The appreciation in a property value, even if you, let's say, consider 3% appreciation every year, so would be around 47k dollars. So total property value, which would be at 347 k. So around you can see like means $47,000 appreciation in property value. So total value would be around 347. So loan payoff, you don't need to pay any loan payoff as such, because there is no loan payoff involved. Then net sales proceeds. So net sale proceed would be as it is 347 or 782 same amount. All right. Now if you look at the total return summary, total cash flow as a income received 400k, and net sell proceed which is received as a 347k. So total distributable amount received around 747k from this investment, and net profit would be here, so around 447. Why? Because you need to debit the initial equity. So once you debit the initial equity of 300k, so you will have almost 447,000 dollars. So this is how, guys, if you see a impact here, See, in one model you have leveraged out your loan to acquire property, and in another model, so you have just acquire property by paying your whole uh, initial amount without any debt. But definitely you would see impact in terms of the profit. So profit would be higher in leverage model, or sometime even lower in leverage model. And in equity, you need a more capital to acquire more assets. So basically, your capital, that is something required higher to you know invest more. So this is how things works in leverage and unleveraged model. You may definitely see a questions around in interview, so you should know it. What is the difference between leveraged and unleveraged model? Or as even investment banker, or let's say fund accountants, or real estate or private equity accountants, this is highly important, so that you should know it how exactly things works in here. With this leverage and unleveraged model, because this is something, it's a pre-work before initiation of waterfall distributions. So now let's talk about quickly. Let's say this is a distributable amount. So how the distribution works, look at this. See, let's say this 666 total distribution amount received to the fund, and then fund manager, let's say, return this to LP and then GP as their capital, and remaining balance would be 366. This is net profit. So out of net profit, so you need to pay 8% preferred hurdle to LP and GP. Let's say 8% would be this. Remaining would be around 246. So that 246,774, you can just then that amount basically goes to next step number 3, and here 30% catch up that goes, 30,000 catch up goes to GP, and remaining amount 216K, so that directly it will split as a carried interest. And here you can see a split of 20% goes to GP, and 80% goes to LP limited partners. And look at this, remaining into GP carry percentage. So this is how things works in leverage models. All right. So look at this, who have made how much amount of money, so that you can understand this model in better way. Initial investment for LP, it was 294. Return of capital, again it was received as it is. Preferred return received 117K. Profit share received 173K. So total the distribution received to the LP 585K, and net profit it was around 291K something. So ROI, of course, which is at a 98%. Now, if I talk about GP invested $6,000. Return of capital, it was same as it is, $6,000. Preferred return received 2,400. Catch up received 30,000, and carried interest received 43,000. So total distribution received to the GP, which is $81,000. And net profit, it was around $75,000. So GP made huge profit out of this, and even LP also made it. So this is how basically distribution works. Now if you look at the summary, so total distribution, it was 606,674. LP share, which is 79%, and GP share of profit, it was 20.73%. And this is a balanced approach, I would say, in this particular model. So now I hope you got it. So means before, let's say, coming to the waterfall, there would be a background work where fund manager or investment management team, they take care of this calculation like leverage and leverage model, and calculate the net distributable amount, so that distributable amount can be calculated and and then distributed to the LP and GP as per their agreed terms and conditions. So this is how things actually works, guys, in private equity. I hope now you get it, how they actually calculate it. So all right, then this is something, this is the another model. I mean, this is unleveraged model. So in the unleveraged model, look at this, how calculation would be. So total equity, it was 300K LP and GP contribution, right? So that was in just second model, unleveraged model. In terms of distribution, it's just normal distribution, LP and GP, and 30% there, 20% GP is extra catch up, and then carry, that would be as it is. But now if you look at the the summary, what it was there, or calculations to just summarize quickly. Annual interest, how did we calculate? Loan into interest rate. So that was 38,000 dollars. Then annual cash flow, income minus interest. Income it was 80k and interest it was 38k. So total the net annual cash flow it was 41k dollars. Then future value, property value. How did we calculate property value? Into 1 plus appreciation, right, yearly. So 1 million into 1.3. So that's how we calculated the property value. Then sell proceed. How did we calculate sell proceed? Future value minus loan payoff. So that's how we calculated the future sell proceed. And total distributable cash flow plus sell proceed. So cash flow it was 207k and property value it was around, means the gain it was received around 449k. So total 666k received from this investment. So this is how, guys, things actually works in leverage and unleveraged model. So yeah, I'm done with this model. If you have any question as such, you can provide your comment in the description. Then definitely I would like to address those as well. So thank you very much for watching this. We'll see you next episode. Thank you.